Good morning. I think we're all set to begin. I understand the conference is running just a little bit late. I hope we had a chance to have everybody join, and we're excited to spend some time with all of you today. Today's session is going to go for about 20 minutes, and we're thrilled to be part of this virtual manager series. And today we're going to be speaking about PIMCO's view of an accelerating opportunity in the distressed and stressed corporate credit market. PIMCO has been concerned about the fragility of the corporate markets for some time. We've been sharing with our clients the vast changes in the ownership of corporate debt and the important market implications. Today, we're going to spend a little bit of time reviewing that and our view of the impending credit cycle and our thoughts on the likely advent of a broad restructuring cycle. First, let me make some introductions. My name is Neal Reiner. I'm a 25-year veteran of the leveraged finance markets. I've had an opportunity to work in investment banking and on the buy side as a portfolio manager. And over the last nearly 10 years, I've been working at PIMCO in our product strategy group, leading the development of our corporate alternative strategies, from our hedge funds to a long lock, absolute return private equity fund styles. I'm pleased to have with me today Jamie Weinstein. Jamie's a 20-year tenure professional in the leveraged finance markets. Jamie leads PIMCO's global leveraged finance investment teams. Jamie joined PIMCO after a long career at KKR, some 15 years, where he spent the last 9 years there building their special situations platform. We're going to have today's session really trying to pose to you and summarize a number of the questions that we've received at PIMCO as we've shared our views with our clients. We're hoping for a really interactive session and do want to hear from you. Our agenda will be for me to pose a series of questions to Jamie, and we're going to talk about the accelerating opportunity set, the dislocation anticipated in the private lending market, and that likely advent of the broad restructuring cycle. With the conclusion of that, then, we're going to look for your questions, and you can add them on the chat side of your screens, and we'll look to take the questions, as many as we can, in that 25-minute period. So with that, I'm going to start. Jamie, let's start at the beginning. Let's look at and share our view of the timing and likely magnitude of this corporate dislocation opportunity set. The pandemic and dual oil shocks were certainly catalysts, but to date, we've really had only a short period of volatility. Will there be much of a downturn, or do we foresee a slow recovery from here? Can you share PIMCO's view on the credit cycle, how it plays out, and maybe a little bit contrast for our listeners how this is different than 2000?
Sure, thanks, Neal. You know, I've been in the space for many years. It's pretty humbling to see how a cycle like this plays out in markets. You know, history doesn't repeat itself, but it rhymes in many ways. I think it's worth spending a moment just kind of recapping the differences between the last credit crisis that we had in 2008 and what we've seen so far in 2020. You know, 2008 was really driven by excessive lending in multiple areas of the economy, but primarily driven by a housing lending bubble, effectively, which led to financial sector failure. You had bank balance sheets that became very difficult to value in that period of time, and concerns about solvency of a number of financial institutions. And as we know, we had some financial institutions fail in that period of time. That led to financial market volatility, which ultimately filtered into the real economy. And then there was a big policy response on the back of that around recapitalizing the financial system and solving some of those market failures, particularly in the way housing lending occurred. We ended up with a pretty slow but steady economic recovery that lasted, you know, for nearly a decade on the back end of that. 2020, a very different set of circumstances. It was a strong economy that was then hammered by a health crisis. Not to mention the additional, you know, you mentioned the oil shock as well at the same time, but that was also part of the health. And then you had the restrictions and the lockdowns, a full sort of sudden economic stoppage on really a full developed economy basis and to some extent a global basis. That then led to a financial market disruption, which then led to another set of policy responses that were very different in nature than what we saw in 2008. And so what did that mean in the context of corporate markets? How did that dislocation play out? Well, the first phase was really one around liquidity. And it was a drawback in liquidity from both risky assets in capital markets, both debt and equity, as well as in what are considered the less risky elements, all the way into the market for treasury bonds. There came a period of time where you couldn't trade off-the-run treasury bonds with anything but a big bid offer, and at some points you couldn't get bids at all. That then led to the first of the series of alphabet soup policy responses, which were largely effective in restoring some level of market functioning. The second thing that happened was the public markets reopened for really high quality issuers, the likes of McDonald's and Disney were able to come to market and issue new debt to effectively solve their liquidity needs, and in particular fill the hole that had been created by the shutdown in the commercial paper market effectively. So some of those high quality companies were able to issue, and then that paved the way for the next phase, which we would describe as sort of phase 2B, the ability of what we would describe as sort of special situations new issuers, high quality businesses that had clean balance sheets coming into the pandemic that needed to raise capital but had to offer security to bondholders. So they created new layers in their capital structure. This was the likes of Carnival Cruise Lines as an example, or some of the airline issuers by Delta and United, or Gap stores on the retail side. Again, they were able to use the financial flexibility they had to offer collateral to issue new secured bonds. The third phase, which is sort of where we are now, is sustained liquidity challenges for some smaller cap companies. They're not able to come to market. They don't have the flexibility to offer the collateral that some of those better capitalized businesses pre-pandemic I mentioned have been able to do. And so they're kind of grinding through this period of a fairly sluggish recovery coming out of the pandemic period. And then lastly, the phase 4, which we think is yet to come, will be a broader wave of corporate balance sheet restructurings when we get later on into this credit cycle. We've been active in each of the first 3 phases here at PIMCO, as I described. Our corporate credit footprint today is almost $900 billion. We're a very active participant in those markets, and we're poised to take advantage of the 4th stage when it comes.
Thanks, Jamie. So quite a bit different market structure than 2008. As we look now, one of the most dominant themes in this transition has been the overwhelming supply of capital in the lending markets and the corollary of proliferation of private capital available for these lending markets. Can you discuss this and the impact of the market dislocations you're expecting to develop now?
Yeah, the market environment coming into this period was one that saw pretty heated action in credit markets over an extended period of time. I would say we saw fairly excessive leverage profiles, particularly in corporate credit, and weaker terms for creditors than we had seen really going into the 2008 financial crisis or into the market dislocations of the 2001-2002 period. Specifically, absolute leverage levels were very elevated. Earnings quality had deteriorated, where you had a lot of what are called add backs to create adjusted earnings or adjusted EBITDAs, as credit market participants would describe. And deal volumes of deals that are called covenant light, meaning they had relatively few maintenance restrictions or no maintenance restrictions on companies, such that the early warning system, kind of the yellow light, effectively, that secured lenders would typically use to tap the brakes with a company along the way, had been eliminated. And so companies were able to kind of go further and deeper into stress without anything happening along the way, and no opportunity for creditors to re-engage. What's different now in this cycle in particular relative to prior ones is a host of what we would describe as structurally disadvantaged long-term holders of credit risk. And really, we're talking about BDCs and leveraged private debt funds, which have exploded in size and in their market footprint in the last several years. They're fairly overextended today in terms of the credit that they've extended to companies. And we think we're going to see some underperformance in their portfolios. COVID-induced weakening of the fundamentals for those companies, we think, will accelerate credit events across those portfolios. Separately, when you look at banks as a proxy, and banks are a lesser participant in corporate credit today than they were maybe a dozen years ago. But just as a proxy, bank loan loss provisions today, private loans, you have the 15 largest banks have set aside $76 billion of loan loss provisions so far in the COVID period. And outside the US, the large European banks have set aside, I think, 56 billion euros. So pretty significant provisions, combined total of 139 billion across that bank loan universe in the banking system. And so we think banks are actually pretty well equipped to handle what's going on, but we think the less capitalized private lending funds and BDCs that operate on effectively thinner capital reserves than those entities, we think relative to the risk is where some of the issues may lie. Also, leverage profiles weakening. If you look at ratings agency downgrade activity, record downgrade pace so far, we think, which can create some dislocations within the syndicated leverage loan market, in particular within CLOs, which are over 60% of the market over the last handful of years. CLOs, we think the portfolio constraints that those ratings downgrades could create some activity as we get more into a default cycle.
That's helpful. I want to delve a little bit into this private loan market that you were referencing. By way of background for our listeners, of course, different than the financial crisis in 2008 that Jamie referenced, traditional lenders have now largely withdrawn from that market due to regulatory capital constraints. And yet because of the oversupply of capital, we now have a $1 trillion market nearly in outstanding private loans. The suppliers of that capital have largely been boutiques, as Jamie mentioned, BDCs or business development companies, effectively closed-end funds that trade publicly, and of course, a host of private direct lending funds. And the challenge is that these are all boutiques relative to the hands of the banks that were extraordinarily well-resourced, conservative credit committees, and of course, did not use leverage. So that's the change in the transition, the provisioning. As a result, the ability to hold underperforming or any type of loan where the coupon or current income might be seated is extraordinarily challenging, very different than the stable hands of the banks. So that's really the difference in 2008, and obviously such a markedly large marketplace. To put that in contrast, that $1 trillion is the size of the public high yield market in 2008. And of course, we have a $2.5 trillion public loan and bond market now. So certainly a wildly enhanced marketplace. For our listeners, PIMCO's view on these private markets and our concerns comes from the benefit of a deep presence. Our recent corporate opportunity strategy has invested close to $4 billion, with the majority of the deals being originated actually in the private markets. And at the same time, PIMCO's originated a significant volume of private performing loans as well, over $10 billion in the last decade. So Jamie, from the vantage point of this seasoned private lender, can you share PIMCO's view of that market now? And importantly, how the private markets will emanate to opportunities now as part of this dislocation strategy?
Yeah, it's an interesting dynamic when you think about the sort of private middle market corporate loan space. Pre-GFC, pre-2008, this was about an $80 billion market. And Neal, as you mentioned, this market is now roughly $1 trillion in size. And anytime you get market growth like that of any kind, on the margin, you're going to have some inefficient allocation of capital. You've had a number of new entrants into the market. Basically, most of the capital that's been deployed in that space is by managers whose businesses in that space did not exist 10 or 12 years ago in their current form. So you have new teams that have formed, you have new credit underwriting processes that have performed, and you haven't had a cycle in that period of time. So these teams and these processes are not battle tested. And a lot of these lending efforts in the firms that they're in do not have adequate workout resources relative to what you might have seen in traditional banks, who used to be the credit providers here. You asked the question, why did this happen? What drove this market growth to occur? And it was really a product of regulatory change and Dodd-Frank effectively and other rules pushing leverage lending activity out of banks and into the hands of these private market participants. So it was a huge opportunity set as banks pulled back and these private lenders filled the void. They came and filled in the white space. We ourselves chose not to be, at PIMCO, aggressive par lenders into this space because we felt like it was very competitive. It was very crowded, and there were a lot of new lenders on the scene kind of pushing terms, pushing price, and making it relatively less attractive than other things that we were seeing.
So obviously an overcrowded market. We've seen this in market cycles from Wall Street before, yet PIMCO has continued to find opportunities to invest. How do you source opportunities in this market? What do you focus on, Jamie?
The first thing you talk about is involvement of financial sponsors in the space, and sponsors are great sometimes to work with, but you have to be very careful when you're working with sponsors. They're very smart, but they look for the lowest common denominator on price. They look for the loosest terms. They're very aggressive on documentation, and when you hear other participants in the market say, oh, the terms are much tighter than the syndicated loan market, it's really just not. In our experience, it hasn't really been the case. Terms aren't all that different. They're loose in both public and private markets. So we think relying solely on sponsors as a way to generate deal flow isn't really a great way to build a sustainable presence in that market. You need more levers effectively to pull. And you see that, even this year in terms of people deploying capital in that space as loans to finance middle market LBOs have plummeted by more than 80%, towards the middle of this year as activity in that space dropped off. You saw a pretty significant drop in market activity, and people had to pivot and find other ways. I'd say, in our case, we're also focused on where the opportunity is going to bubble up from. If you think about those entities that we talked about as being disadvantaged, the middle market lending funds, the BDCs. Let's just touch on the BDCs for a second because it's an interesting piece of context. They trade at pretty significant discounts to NAV, which those discounts are less so today as the markets have re-rated back upward throughout the summer and here into the fall, but still fairly meaningful discounts to NAV. So you'd either argue that the marks are lagging or the market is still taking a forward look that there's more credit losses to come. For us, where are we looking today? Our current pipeline is really building. It's capital solutions opportunities for some of those private companies that can't access public markets. It might be things that relate to real restructuring type capital for those businesses that are already fully levered coming into the pandemic and economic slowdown and are going to need the tools of restructuring in order to bring in new capital because they don't have fresh collateral to effectively offer. But we think this is going to take several months. It's here, beginning here in the last quarter of this year, but we think it's really a trend that will play out over the course of 2021 as well.
Thanks. I want to pivot now to that final phase. We're spending a lot of time on that phase 3, the private companies that will face acute liquidity needs, and of course, the holders, as Jamie described, are structurally disadvantaged to hold underperforming credit. But the fourth phase we highlighted was restructurings. Can you talk a little bit about what the magnitude of the opportunity is now in public restructurings? Yeah,
very good question. I think one number just to highlight, just again, the size of the markets that are addressable. Neal, you mentioned $2.5 trillion of syndicated loan and high yield capital as a target zone, plus that $1 trillion of private credit capital we talked about, total of $3.5 trillion. If you apply Moody's default estimate, I think it was 12.5% in their most recent report, obviously you get an addressable universe of several $100 billion that's going to need to go through restructuring. We think obviously leverage terms, as we mentioned before, are going to be a driver coming into this as just companies came in fully levered already without a lot of financial flexibility. But also you think about secular changes, some of these businesses that are going through real change that's not just a COVID cycle. It's not a V-shaped recovery for some of these businesses. Some of these experiential businesses, we think there might be real declines in capacity needed over time. Some of the things around travel and tourism and leisure that may restructure and need lesser capacity. Obviously, the commercial real estate space separately is a large area of opportunity, but also retail, for example, another one where we've seen a significant wave of defaults. And you could argue that it's COVID-induced to some extent, but it's less so COVID-induced, more COVID-accelerated, where some of these secular trends were in play for a long period of time, and COVID just kind of pulled forward the issues for those companies. Some of the large restructurings, just as an example of things we've been involved in at PIMCO over the last several years, TXU, iHeart, PG&E, Caesars, and most recently, the successful exit of Neiman Marcus Group. Speaking of brick and mortar retail businesses that went through a balance sheet restructuring. So we think this is an environment where you need to be staffed up effectively to be able to do both top-down work as well as bottoms-up work. We leverage a team of 65 credit research analysts and a number of specialist resources around insolvency and restructuring, be able to identify these opportunities and really work our way through. And we like to use our scale as the largest creditor in many of these cases, to be on a steering committee and try to drive terms and economics for our investors.
Thanks, Jamie. I wanted to certainly allow time for questions. What we tried to convey to our listeners today was to share our views on the macro opportunity set that's developing from the vantage point of PIMCO. You know, we have an enormous lens into the marketplace from our $350 billion plus presence in the corporate credit markets, our $35 billion alternatives presence, and of course our long-term presence in the private lending and distress markets, as Jamie said. As we look at this developing opportunity set, there's probably no more of an alternative opportunity set that aligns directly with what PIMCO's resources. As you heard, we remain convicted that the corporate credit markets are quite fragile now and are poised for sustained volatility and a deep period of underperforming credit, highlighted largely in the private credit markets. We'd be pleased to share our more details about our views and various strategies of PIMCO that can capitalize on these opportunities should you have further interest. But right now, we really do want to hear from you and address your questions. Please use the session chat to your right to post questions to us, and we'll get to as many as we can now during the session. Let me just pause there and see what questions emanate. I think there are a number of questions. Let me start, Jamie, with a question around how the Fed programs may alter the opportunity set that we've discussed. We've seen some help to middle market businesses and our fallen angels. How does that impact the opportunity set?
It's a great question, and it's something I think a lot of credit market participants have been grappling with ever since Jerome Powell rolled out some of the programs beginning in March that the Fed engaged in with support from Secretary Mnuchin and the Treasury. The Fed's involvement in markets has clearly clipped the extreme left tail. So when you go back and you talk about those four phases of the market that I described earlier, the Fed eliminated the risk of a disorderly, illiquidity-driven market meltdown, broadly speaking. So companies that should have had access to credit markets, high quality investment grade businesses, are able to access the markets, and the Fed has ensured that access. Their participation across corporate credit markets going down the risk spectrum into the lower reaches of investment grade, and even then their participation in the high yield market is intended to drive liquidity into the system rather than picking credits on a haves and have-nots basis. Obviously, when you pour in as much money as the bazooka that central banks like the Fed and the ECB are able to use, you do create impacts in the market. You've created tightening credit spreads across the board, but also because you've signaled to market participants that it's safe to go back into the water. But what they're not doing is capitalizing businesses who will otherwise default. They're not buying CCC bonds broadly. They're not lender of last resort to companies. Those programs don't exist. And so while they can participate on a broad basis and support broad market functioning so that lenders can trade securities amongst themselves, or bondholders can trade securities, and companies can print new issue, they're not supporting companies that would otherwise be on the verge of bankruptcy. So from the perspective of what does it mean for a default cycle and how does that play out, we think it may elongate the period of time because some companies on the margin may be able to access capital more cheaply than they otherwise would. But the issue coming out of all of this at the end of the day is companies are going to come out of the pandemic period with more leverage on their balance sheets, gross and net leverage, than they came into this with. And they do not exit this period of time with enhanced earnings power. So if you have more leverage and you don't earn more money, you're laboring under a heavy burden. And we think that will lead to incremental challenges down the road and frankly, an elongation of what would have otherwise been a sharper default period.
Thanks, Jamie. I'm also getting a series of questions that I'll try to congeal on maybe switching our view now to that of an allocator and how to capture this independently in public versus private markets in our views. Let me start there, and I'll turn it over to Jamie for additional color. We speak to an enormous number of highly sophisticated investors, from institutional allocators to a range of family offices and sophisticated individuals as well. And I think this comes up often. There will be opportunities in both markets. We think it's essential when you're talking about special situations to be able to have the flexibility to be able to pivot from the private markets to the public markets. As Jamie indicated, we do see a sustained opportunity in the private markets. Excessive overcapital has led to over-leveraged companies. And as we mentioned, the holders of that credit are not well situated for any underperforming situations and will desperately need liquidity. Having said that, there are periods of volatility in the public markets. We've seen that knee-jerk reaction in March, April. Jamie and the team were able to capitalize on that rapidly with the benefit of the 65 corporate credit research analysts that Jamie mentioned. And we think this is essential to be able to prosecute this opportunity set, whether it's Europe or US, public or private. You need a broad-based manager to be able to have those lens into those markets. Jamie, let me pose the second half of that question to you. How do you see default rates panning out in the private lending market compared to the more liquid corporate sector?
I certainly don't see it being lower. And in fact, it's relatively difficult to get good data. But private credit markets in general, you think about where private lenders play, they play in the single B and triple C space, right? So you need to look at default rates for single Bs and triple Cs in the syndicated market, not the broader high yield default rate or the broader corporate credit market default rate. But I don't believe private lending will outperform those sectors. In fact, in many cases, they're taking on smaller companies, narrower businesses, maybe more customer concentration, maybe more risk around a management team or margin structure in an industry or competitors. There's reasons those companies are smaller. They can be very good companies, but in general, if they were larger and broader and more scaled, they'd be in the public markets. So I would expect to see the same or higher default rate in private credit as the lower reaches of the broader syndicated credit market.
And just to overlay the market experience, the only barometer we have for valuation in the private market are these publicly closed-end funds, BDCs. And as Jamie mentioned, unfortunately, the returns to investors have been quite poor this year, as not only the NAVs have been marked down, but as Jamie mentioned, investors have actually created even further discounts in their valuation, anticipating more erosion in the credit quality. So as we think about what the evolving opportunity set or distress in that sector, investors, at least on market value, are telling you relative to the public market, home of much larger, more capital friendly issuers, is telling you that there is some danger there. Obviously the coming quarters will play that out. Let me move on to another question. Is there too much supply of capital now in this strategy? There certainly are other managers, in addition to PIMCO, looking at this strategy. Jamie, can you talk about that a little bit? Jamie, not sure if you're on mute. We may have lost you audio. While Jamie is amending his audio, I'll be happy to weigh in there. This is the largest market we've ever seen in history. We've entered it with leverage profiles at record levels. We've entered it with another almost $1 trillion of private capital that's now accessible to managers like PIMCO. Adding up, that's $3.5 trillion. Moody's alone, on the public market, they don't rate private credit, obviously, has suggested a baseline 12% default rate. That's default, not even weakening, restructuring, or acute liquidity needs. That's obviously a very, very large number. We do not think it's oversupplied. I do think you can evaluate managers based upon their target fund sizes for a suggestion of where they are looking for opportunities. And there are many managers out there looking for $15 or $20 billion that are obviously going to be focused on only the largest public opportunities. And there's also smaller managers out there that are focused on much smaller funds. What I think investors really benefit from is those managers that have extraordinarily strong resources, platforms to be able to pivot to different opportunities. We discussed the public and private, but at fund sizes that are targeted to allow their portfolios and their investment teams to benefit from a smaller $100 or $150 million transaction. And again, we can spend more time on what we think is investors should be looking for in evaluating managers in this space. With that, I think I have time for one more question. Jamie, will the election change the trajectory of the dislocation at all? Is there any implications that we can take at PIMCO from the leadership under either party that could possibly alter this trajectory? Jamie, unfortunately, it looks like we're continuing to have audio problems. I'm sorry. Obviously, it's your connection, nothing that you've done. But it turns out that we are really at our last minute. I've been given the cue by the producers that we do need to wrap. We really do appreciate everybody's time and engagement today. We'd encourage you to visit PIMCO's Expo booth by using the Expo tab to the left of your screen. And we'd ask that you now return to the main stage for the next session, which is the Alpha of Inclusion. And thank you very much for your participation today. We look forward to engaging you further with any questions you might have. This concludes the session. Thanks.